You're looking at a daily chart of the Nasdaq. This is my daily review. Thank you for watching. I'm just going to start off here with the old January to February 2nd run, the 15%, the old pullback below the 50% retracement of the move. Then it ran through the 50 here and then kind of stalled and went sideways. And I know people are getting really frustrated with the choppy action, but it traded down to the 21 and today popped more than 1.79% on volume that was higher than the last couple of days, actually. But so that constitutes a follow-through day on day 13 of an attempted rally. The most successful follow-through days come days 4 through 7, but that doesn't mean this one can't be successful. My rule is to buy something on a follow-through day, and I'll get to that in a minute. But anyway, that's the Nasdaq. I don't trade the Nasdaq. I don't buy the Nasdaq. And but I do trade stocks and I buy stocks, and this is Apple, which looks a lot like the index. It's outperforming the index actually by quite a bit. The index is up like 15% this year, and Apple's up like 25%. So Apple's performing well. Microsoft is one that we've been mentioning here. It was traded in this like a flat base here, the stage 1 base. Went sideways yesterday, came down to its 10 EMA, and today popped nearly 2%. Nice move on Microsoft. And these big behemoths, these are the ones that are going to move the needle here on the indexes. Amazon, another $1 trillion market cap, had a nice day today, up 3%. Struggling with that 100 number. And Adobe is another one that I like that looks, shouldn't say I like it. I like the chart setup, as it was trading tight in here and then moved 1.5% today. I don't like any of these big stocks, are too big for me. NVDA, I'm going to move to the semis now. I'm going to have a little different format today, but the semis did catch a bid today, and NVIDIA is definitely a liquid leader, and it was up more than 2%. It's having trouble with this 270 number. We'll see if it can get over that hump here. It's had a real strong move in 2023, and it just pulled back. These 3 days had a little bit of a breather. It got more than 60% above its 200. Yeah, right there, 60.1% above its 200 simple moving average, and pulled back to the 10 and just traded higher today. So congrats to the longs there. ACLS, this one, it tricked you. This is tricky here. It traded below the 21. Looks like it was going to give it up and go back to the 50, but nope. Now it traded up today and now is well above all its moving averages, above the 10 and the 21 anyway. A nice 6% gain for ACLS. LSCC is another one that I like and I hold, and it's did kind of the same thing. 3-day pullback, went below the 21, today bounced, found support and bounced. That's what you want to see, the support off of moving averages. This is STM. You got to look at the weekly here. This is a slower moving stock. It's got a lot of shares outstanding. 900 million outstanding, 650 million in the float, but you can see the cup with handle pattern. Had news today. They had an investor meeting and dividend, and anyway, the stock popped 4%. You can see the last 2 days. Good volume on STEM. Another semiconductor, they report tomorrow, AEHR. Again, the 3-day pullback to a moving average, found support and popped nearly 7% today. This one moves a lot. Anyway, I'm going to, like I said, a different format today. I'm just going to look at some stocks that I like. Some stocks that have been on our watch list. You can see why. This is Workday. Got in this little flat base pattern, traded really tight in here, and today popped 4.5%. So congrats to those who picked up on Workday. Palo Alto Networks, another one that I really like. Had formed this little bull wedge pattern back to the 21 and popped, and now it's doing it again back to the 10 EMA. So, overall, though, if you take a look at the weekly, you can see this, it's just still consolidating in a base, and it's kind of flattening out here for like the last 4 or 5 weeks. Another one that I like is HUBS on our watch list. HubSpot had a nice move today, 2%, but to me, it's still in the base. It's 3.1% above its 10 EMA, so might want to let it handle out sideways if it's going to allow you to do that. It might just take off, depending on the market, of course. But that one looks good as well. For This is one that I bought for, fall today. You got to buy something. And I should have had this on our watch list because I like this short little downtrend line. And it's pinching in here in this little pennant pattern here. It's got the, the growth, EPS growth. It's got the growth profile that I like. And so anyway, I picked up some for today. TGTX is a speculative stock that I like. It got approval of its multiple sclerosis drug, had a big run. Now it's pulled back. You could see it was 150% above its 200. Yeah, now it's pulled back, just trading nice and tight and flat, just waiting for news. Good news, it'll go higher. Bad news, probably go lower. But now it's 61% above its 200. It's slowly rising 200. ELF is another one, made a new high, formed this shelf here, and now it's trading higher. I think it's moving out of this little shelf area and into another higher ground area. Shelf is one of my top holdings, as well as NVO. This one did the consolidation pattern, had the shakeout here. It had some kind of news. I forget what, some competitor had something, or they lowered their insulin prices or something. The world was coming to an end. And people, sold. You could see the big volume bars. They got out. Then what happened? The shakeout, then the breakout. You're moving to higher ground here now, and it's moving away from that base. And I know a lot of you in the, the MC stock chart subscriber list are on that stock as well. Anyway, I wanted to compare three stocks. The shoe stocks, I like all three of them, so don't at me, okay? Oh, I'm just going to compare them. This is ON Holdings. I see these at the gym, very popular in the, I'd say casual wear, athletic footwear. It's not really a running shoe, but I see a lot of, men and women both wearing them, not really kids, but teenagers to elderly people like this shoe. They don't have any debt. You could see the up down volume 2.1 right now. Yeah, A- accumulation, distribution rating. A lot to like about this. This is not a short stroke. Somebody was saying this is a short stroke pattern. Don't think so. It's down, had quite a range there, 31 to 21 this week anyway. And the volume is really high. So you want a quiet week on a short stroke. But anyway, Owen, I believe they're taking market share from who? I don't know, maybe from Nike, maybe from I don't know, New Balance or Brooks or they're taking market share, obviously, by their growth, and they reported 89% sales growth, and they guided to 60%. So, but the problem I have with this stock is now that it's got a 316 shares outstanding, 208 million shares in the float, which is traded daily. So it's got, over 100 million shares they can unleash on either preferred or restricted or options by management. If you listen to Peter Lynch, he doesn't like management owning a lot because they can dump it. They can load it at any time. And anyway, it's got no debt. It's just got management and it's with a lot of shares, and it's got a big market cap here. It's 9.5. Actually, it's even higher than that, huh? Stocks in the group, 9.61. Okay, more than 9.5, almost 10 billion market cap. Decker's almost 12 billion market cap, and CROX 7.3 billion market cap. Those are the three stocks that I want to show you. Anyway, ON, nothing wrong with it. Had a big breakout, and now it's holding its gains. So once again, I like the shoe. I like the stock. It's not a running shoe. It's a gym shoe. It's an athletic footwear, casual footwear shoe. But if people want a running shoe, they're going to go with New Balance, Brooks, Nike, Saucony, Asics. But this is not a running shoe. It's more casual and athletic footwear. And speaking of athletic footwear, Deckers has the Hoka. These things have been, really popular. You can see the sales growth here. ON had 1.2 billion in sales last year. Deckers had that in a quarter. Okay, and the market caps are pretty comparable. The PE here is 24, whereas ON the PE is 102. It's very rare to see a footwear stock with a triple digit multiple. So a lot of growth is priced into ON. Deckers has also the UGG boots or signature shoe is the UGG, and it's worn by teens and older people. It's casual footwear. It's got a broad appeal. Once again, they have no debt. They have tremendous cash flow, return on equity, excellent balance sheet. The up-down volume 1.1. So, people like the stock. Accumulation distribution is a D. But once again, look at here, only 26 million shares of supply in the float, okay? And management owns 1%, so we like that. They're not going to dump a bunch of shares on you. And the last one in the footwear, I believe all three of these are taking market share. CROX, the problem with CROX is it's getting saturated in the United States. They talked about single-digit growth in the United States, but they bought Hey Dude, and they acquired a lot of debt, and Wall Street does not like that debt. Does not like the fact that they only guided to, I think, 10% growth this year, and here it is, 2023, only $11.19. So it's got, and next year, 15%. So we'll see about CROX. It's got tremendous cash flow, return on equity. It's just the debt, and it's getting a little saturated in the United States. But they bought Hey Dude. It's only sold in 3 countries, where CROX are sold in 110 countries. I believe of these 3, this is probably the best value here. If the multiple gets, up to where Deckers is, or even half of what Deckers is. Deckers is what, 24, if you give CROX an 18. With the, this is 24, and CROX multiple is, 11. So if you give it 18 with the, they guided to $11.31. They're probably going to come in next quarter and say now 11, 05 to 11.45 or something. And at the end of the year, they're probably coming to earn closer to $12. That's just the way they sandbag it. But technically, I mean, this thing's below the 50. Fundamentally, I like it. It's just going to take a quarter or two for them to pay down their debt and tell their story to Wall Street. And they have to prove that Hey Dude is going to be a viable option to the clog, which I say is getting saturated. I shouldn't say saturated. They're still going to have 6 to 8% growth in the United States, but they're growing globally. They just got into, foreign countries, and they have a lot of growth in that area. Anyway, those are the 3 stocks. Of the 3, I do like CROX, and then Deckers, and then ONON, because it's just the valuation on ONON. But I do like the shoe. I wear the shoes. And anyway, that's it for today. We never give up.